Raise your hand if you love staring at stock charts for 3 hours a day, reading quarterly earnings reports until your eyes bleed, and panic selling every time the news says the word recession? Yeah, me neither. Life is too short to stress over whether Tesla is going up or down by 2% today. You have a job, you have hobbies, maybe you even have a social life. Weird flex, but okay. Here's the truth. Trying to beat the market by picking individual stocks is like trying to beat a casino. The house usually wins, and you usually end up with a headache and less money. But what if I told you the best way to get rich is to be lazy? Welcome to the Set It and Forget It strategy. Today, we're talking ETFs. First off, what is an ETF? It stands for Exchange Traded Fund, but let's skip the finance textbook jargon. Imagine you're at a grocery store. You could spend an hour picking out the perfect individual strawberries, inspecting each one for bruises. Or you could just buy the pre-packaged fruit basket. It's got strawberries, grapes, melon, it's got everything. An ETF is that fruit basket. Instead of buying one share of Apple and praying, you buy one share of an ETF, and suddenly you own a tiny slice of Apple, Microsoft, Amazon, and 500 other companies instantly. One click, instant diversification. Why does this matter? Because companies, even big ones, fail. Remember Blockbuster? Remember asking Jeeves? Exactly. If you put all your money in one company and it tanks, you're eating instant noodles for retirement. But if you own the whole market and one company fails, you barely feel it. It's the safety of numbers. As the legend John C. Bogle said, don't look for the needle in the haystack. Just buy the haystack. Buying the haystack is so much easier. You don't get pricked by the needle, for one. So, which baskets should you buy? I'm not a financial advisor, just a guy on the internet, but here is the classic Boglehead 3-fund portfolio. It's simple, it's boring, and it works. Total US market, like VTI. This is essentially buying America. Every public company, big and small. Total international, like VXUS. Because contrary to popular belief, the US isn't the only place with money. This gives you exposure to Europe, Asia, and emerging markets. Total bond market, like BND. These are the vegetables of your portfolio. Not exciting, but they keep your portfolio healthy and stable when the stock market throws a tantrum. Now for the best part, the set it and forget it part. The biggest enemy to your wealth isn't inflation or taxes, it's you. It's your emotions. When the market crashes, your brain screams, sell. When it spikes, your brain screams, buy. We want to remove your brain from the equation. Set up an automatic transfer the day you get paid. The money hits your account, the robot buys the ETFs, and you go live your life. You literally can't mess it up if you aren't touching it. And while you're off living your life, Albert Einstein's favorite invention is working for you, compound interest. Look at this chart. That curve? That's your money-making babies, and then those babies growing up and having their own money babies. It starts slow, but give it 20 or 30 years, and it goes vertical. Quick side note on fees. Active mutual funds are like that friend who orders the lobster and wants to split the bill evenly. They charge high fees, expense ratios, that eat away your profits. ETFs are cheap. We like cheap. Over 30 years, we're talking about a difference of tens of thousands of dollars, just by choosing the low-fee option. Okay, so you bought the funds. Do you never look at them again? Ideally, yes, but maybe check in once a year. There are basically 3 ways of allocating the assets, based on how you want to balance them. Let's say you wanted 80% stocks and 20% bonds. But stocks had a great year, and now you're at 90% stocks. You're taking on more risk than you planned. This is called rebalancing. Once a year, you sell a little of what's high, stocks, and buy what's low, bonds, to get back to your 80-20th split. It forces you to buy low and sell high without even thinking about it. Genius, right? I'll keep this brief because taxes are boring. Basically, ETFs are structured in a way that is very tax efficient. Uncle Sam waits until you sell to take his cut, unlike mutual funds which can hit you with surprise tax bills at the end of the year. Let's review. Stock picking. High stress, high risk, requires research. ETFs. Low stress, market returns, requires zero brain power. I know which one I'm picking. Here is your homework. Open a brokerage account. Fidelity, Schwab, Vanguard, doesn't matter. Pick 2 or 3 broad market ETFs. Set up an auto deposit, and then go for a walk. Read a book. Learn to knit. Do literally anything other than checking your portfolio. Your future self, the one sipping a margarita on a beach paid for by compound interest, will thank you. If you found this helpful, smash that like button. It's free, just like the best financial advice. Let me know in the comments. Are you team stock picker or team ETF? I'll see you in the next one.